The dollar's getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. Economic growth is incredibly weak. So we've got sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table, 130%? The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. We'll hear from them at some point, but we're in a recession now. And people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP and they come in at different times with different lags and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But here's what we think, here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number. But they don't guess at the stuff they don't have. And it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3.
The game these financial planners play is they only show you charts going back to 1981. And this is when Paul Volcker raised rates. So since then, we've been in a down cycle in interest rates. And you can say the stock market always goes up, right, if interest rates are always going down. But what happens when interest rates start going back up? And usually the cycle is about 30, 40 years. So if you look at charts of the stock market going back to 1927 to 1980 or 81 adjusted for inflation, it was pretty much flat. But see, they don't tell you that.
But something even worse happening is the last crash was, let's say, 2008 when the repo market reversed and all this stuff. And most of these financial planners and real estate brokers, all they know is a rising market. Since 2008, we've been nothing, and happy days are here again because they kept dropping interest rates. Real estate went up, stock market went up, bond markets went up. So you make some money, you pay your taxes, and let's say you put $100 here. It's the bank's liability. But on your balance sheet, it's an asset. It always has to balance. That's why balance sheets are everything. So they have, let's say, one of your dollars here in the fractional reserve system, they can ramp it up 10 times, let's say. So your $1 becomes $10. And then Kenny walks in and borrows it. So they now have an asset called Kenny's debt. So it always has to balance. It's, in scientific terms, it's called counterparty. Who's at risk here? So they need Kenny to come in and borrow that money. The Fed, as we know it, is a third central bank. It is not U.S. It is not federal. It has no reserves. It has nothing. It is a cartel owned by the Rothschilds. So what happened in 1913, the Fed was created and the 16th Amendment was passed because money had to come in through taxation. So when they print money, the only way they get it back is via taxes.
That's the way the whole system is. I'm borrowing from insurance companies. I'm borrowing from pension groups. Like the retired teachers or firemen or police. They all put their money into pensions, and then those pensions, they lend it out again. So what they're always looking for is they're always looking for people to put the money into the system, and then the financial planners, the wealth managers, the money managers, whatever you want to call them, their job is to actually go out and find people like you to lend it, to open businesses. So the money is sitting here, it's OPM or other people's money, and it needs to be lent out.
Debt to GDP is sky high, economy weak at best, probably out of recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working. Prime age 25 to 54 years old. It's never 100. I mean, there's always, you could be a homemaker, a student. They're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or depression level, actually. The baseline deficit is $1 trillion, so your deficit's out of control and your trade deficit's out of control.